Hey guys, Omar here, broker and CEO of Alden Mortgage and OMA Realty. So I know we've done a couple of videos on DSCR loans. So this video, we're going to go ahead and explain what DSCR loans are. We're going to price out some DSCR loans, so keep tuned or stay tuned, and you could actually see the difference between a DSCR loan and investment loan, and then we could go ahead and price out a couple of other different loans. But the DSCR loan, which is called the debt service covered ratio loan. A debt service covered ratio just means that the debt that we are, acquiring, they will have a service and then the ratio, the covered ratio. So that means that the service is going to be the rental amount. The debt is going to be the mortgage that you're going to go ahead and obtain. And how much is it going to cost from one to another? So for instance, if we have a debt of monthly principal, interest, taxes, and insurance of, hypothetically speaking, let's say $3,000 a month, right? Your covered ratio, if your rental amount is at $3,000, that is a 1-to-1 ratio. So that was, in essence, as simple as you could possibly put it, what a debt service cover ratio is. Now, a debt service cover ratio is usually a mortgage product that is for long-term investors, for people who have, not long-term investors, I apologize, but more people who have a bigger portfolio, because you can't qualify for other primary residence or second home and even investment properties, those types of loans. These are for people who are actually, multi-unit investors. And this is something that you would probably want to know later on down the loan when you get to 15, 20, maybe 30, 40 units, doors. And then this is going to be a loan product that you're actually going to obtain. So debt service cover ratio, the debt is covering, or the service is going to cover the debt that's going to be it. And then the ratio is going to be what we're going to be at. Now, typically, you do not want to be at a 0.75 or below. Hypothetically, you would want to stay between a 1.25 and or above if you could go ahead and maintain that. That is going to be the best case scenario. This is going to have the best chances of us going and approving it. And then especially when it comes to, beginner investors, right? Beginning investors, this is going to be one of the most difficult things that you're going to have to go ahead and overcome, because you have to find that right deal. You're going to have to make sure that the market rental rates are actually in your favor. And that way, this is going to go ahead and go as smoothly as possible. But let's go ahead and price out a DSCR loan. And then what we're also going to do is talk about, is this going to be right for you? Now, I always employ people. I don't know if that's the right word to use, but I always encourage people, especially first-time investors. DSCR loans is a great loan. It's an awesome loan. Investors have been using it a long time, but is it right for you as an initial investor? Let's say you're just going to get your feet wet. You're just trying to get into it. These aren't loans that you would want to go ahead and get right out the gate. Ideally, what you would want to go ahead and get, you would want to get something that is between 2 to 4 units. You would want to get a duplex, a triplex, a fourplex. Those are ideally what you want to do, which you are in turn going to go ahead and make one of them as your primary residence. Which, if you make one of them as your primary residence, this puts you into a more conventional bucket, which lowers the payments as far as obtaining a loan. So let's go ahead and price out a couple of these loans, and let's see exactly the cost difference between them, and see so you get a better idea of what the cost is between one versus another, and how is it going to work out in your benefit. So let's go ahead and price these out and go from there. All right, so right now we're looking at our loan screen right now. Our loan screen right here, this is a drag and drop. Now, this is a wholesaler that we go ahead and send to. For the sake of argument, I'm just going to use this program. Now, we do have a program that we use that is called Lending Pad. That is the primary way of us using it, and that kind of funnels all the different lenders out there and tells us exactly where we're at. But then after we go ahead and get the 3.2 or the 3.4 file, we go ahead and drag and drop it into whatever wholesaler that we're going to end up selling it to, and then this is the screen that we're going to go ahead and get into. So what we're going to go ahead and do is, let's just go ahead and say that we are at a 740 credit score. A 740 credit score with a 30-day lock. Now, what's a 30-day lock? A 30-day lock just means that we're going to go ahead and lock this rate in for 30 days. Now, of course, I'm going to put myself as the loan officer on that. We're going to go ahead and use this as a test. Now, for the first one, what I'm going to go ahead and do is we're going to go ahead and price out a single family residence. Okay, we're not going to get all crazy because I want you to see the price on exactly what this is. Now, I don't want you guys to see what my compensation is for this because I hate it when, people kind of over glorify how much they make and all that other stuff, and it's pretty annoying. And you don't need to see how much I get paid. So we're going to go on a conventional loan. We're going to say, let's say for the sake of this argument, I have a couple here that we did before. Let's just say it's $765,000. Actually, I'm going to go down to $500,000, and we are going to actually change this from a conventional over down to, let's say, we'll just go ahead and stick a conventional on this one for right now. We're going to go ahead and do the sale price is going to be at $500,000, and then the appraised value is at $1,000, and we're going to do let's do a 20% down for this one, and then after this one is done, then we're going to go ahead and we're going to go a little bit on the higher side after that. So we're going to go 80% loan to value because we're putting 20% down, which will give our loan amount right here at $400,000. And this is all just to give you an idea of exactly how much it costs, so don't worry about the other stuff. We're not going to do any waiving underwriting fee because when you waive the underwriting fee, it's not always in your best benefit because then that actually hits you on what's called the APR. The APR is actually what you're actually paying for the loan, and then the rate is going to be the face value of the loan. So there is going to be a little difference there. And let's see if I forgot if it's going to go ahead and give me anything. Let's go ahead and pop this. It's going to be California. We're going to go ahead and give we'll do that one. We'll do it in LA. Let's see if it'll give me a quote based off of no income, no taxes, no monthly debt, or any of that stuff. So this is on a conventional. Now, conventional, if you look, these are going to be your prices. This is going to be your principal and interest right here. This is going to be the dollar amount that it's going to cost to go ahead and get that rate, the final price, the base price, and then the interest rate. So this is going to be on a 4.875, which at 4.875, and that we're currently at in April 2022, April 24, 2022, you are actually going to get a refund of $72. $72 is going to be what you're going to get on this one. So that's actually not that bad, right? Your principal interest is at $2,116. Now, in whatever county, whatever city that you're in, if you could find a duplex, you could always just go ahead and, get one and then rent the other one, which will kind of cover this. This is on a conventional, where you could make one as your primary residence. Now what we're going to do is we're going to go back up here and we're going to go ahead and change this guy around from a conventional. Let's get out of here. Conventional arm. We're going to keep that the same way. We're going to go ahead and change this over to your occupancy is going to be an investment. Okay, investment with the same loan amount. Everything stays exactly the same. We're going to do 4 units, okay? 4 units total for 500, just kind of get an idea of what this is actually going to pull up for us. And of course, the purchase of the home. Now that gave us nothing. Now, why did that give us nothing? Let's kind of figure this out. Give me 1 second. Single family residence, 2 to 4 unit dwelling. See if we get a quote on that guy. Okay, so this is the difference between what we have as far as an investment loan. This is going to be a DSCR loan because this is an investment occupied for 14 days. It's going to be 2 to 4 units. Now, this is really important when it comes to initial investors, so you get to see the price difference. Now, that same home that was at $2,100 before, somewhere around there, it was like at $2,000 or $2,100, your principal and interest. That is actually now going to cost $5,676 to go ahead and get it at the 725 rate. So there's a really, really big difference whenever you're doing this investor loan versus, this DSCR loan versus a very conventional loan. Your everyday run-of-the-mill, Fannie Mae, Freddie Mac product, because this is what's called a non-QM product. Now, this is going to be a final price. Now, let's say, for instance, we wanted to get into that 4 range that we were looking at before. Now, the 4 range that we're looking for before, that will give you a final cost of $24,100. That's because this is an investment loan, right? This is a more riskier loan. This is a non-qualified mortgage loan, but this is something that you're going to have to go ahead and calculate, especially when you're getting into your investment portfolio and building it up. When things get a little bit more expensive, it actually when your portfolio actually increases and the liability is more on getting rental income, because you do take a little bit of a hit because it is an investment loan. But let's see what happens when you change the loan to value at 70. Let's see if that makes a bit of a difference if you put a little bit more skin in the game. Now before we did 20% loan to value, 350,000. Let's see, get a quote. Let's see if that actually changes anything for us at all. Now, and it does. So when you put 30% down, the risk, this is called risk mitigation, and the more skin you have in the game, which a lot of investors have, they usually put between 20 to 40% down, somewhere around there. And the more money you put down, the less it costs. So at 5.75, which is a pretty big jump from the other one, that is, that's actually on a conventional elite investor flex. So on an investor flex, that is actually going to end up costing you roughly about the same amount, and it's still going to be at 7.25. Now, this is still without origination charges, but you see how much of a difference it is if you actually went to the conventional side. If you went to the conventional side, you're actually going to be pocketing $591.50. So this is a difference between, whenever you're getting into the real estate business and then you're looking for lending options to go ahead and get into it, this is actually going to be the cost of everything. Now, of course, this is just principal and interest. This has nothing to do with your taxes, insurance, and all that other stuff. That is going to come up here, which we did not do. If you had, homeowners insurance, that's going to be one of them that's going to be annually calculated. Monthly income, we really didn't touch any of that stuff either. But this is just for, informational purposes, just to give you an idea of exactly how much of a cost difference it would be to go ahead, especially in initial investors. It's going to be way cheaper to go ahead and do it this way than it would be on a DSCR loan. But when you are going into the DSCR loan range, you are going to be paying a premium because this is going to be a non-qualified mortgage. And the reason why that is because there is not an insuring body. The insuring body is the 2 biggest corporations, which is Fannie Mae and Freddie Mac. And those people, they do not do unqualified mortgages, because qualified mortgages only fall under the VA, FHA, USDA, Fannie Mae, Freddie Mac, those buckets over there. But when you go to these ones where it's non-qualified, those insurance bodies are no longer there. So these are going to be pretty much kind of like private money. And private money that's going to be in a portfolio where investors are going to go ahead and this is how they mitigate their risk. So in essence, I want to go ahead and show you exactly what the price difference is on a conventional 30-year fixed. That is going to be at 5.75. That is going to put your total final price at $591 that you will get back. That's $591 that you would get back on this loan. Now, let's say for the sake of argument, you went ahead and took the highest rate you could possibly take, right? Now, that's still going to be less of a percentage than the DSCR loans, right? The debt service coverage ratio loan. The debt service coverage ratio loan, you're at the highest rate, you're going to be paying $3,216.50. That's at the highest rate right here, 725 base price, the final price, that's how much you're going to be paying. At 6.75 on a conventional, you're actually going to be getting a credit. So these little parentheses right over here, that just means a credit, because the final price is right there. That's a negative. Anytime you see a negative in parentheses, that's money you get. You get paid $8,032.50 to obtain that loan. So I hope this kind of helped you guys out a little bit. Let me go ahead and close this guy. Let's stop the recording. So that, in essence, is how the two programs, kind of like one will go ahead and benefit you in the initial part of investing, and the other one is something that you're going to have to take into consideration when you are actually purchasing a loan on the debt service cover ratio. Now, this is going to be in any type of investment loan. It's going to always cost a little bit more because these non-qualified mortgages are way more riskier because you are relying based off of people paying your rent. Now, does this make sense in the grand scheme of things? No, I honestly don't think so. I don't get how this is a difference, but it's not my money. I'm not the one lending it. I'm not the one I'm not insuring it. So it is what it is. So if you like the content, like, subscribe, comment. If you want up to 50% commission rebate on your next real estate purchase, investors are all welcome. I have a bunch of investors that I work with, and they kind of, use me for this purpose to go ahead and make sure that they get a little cash back. Because the name of the game, especially when you're investing and especially if you're doing things for income purposes and you're trying to build a portfolio, any little bit that you could get back is always a plus side. And then if you have any mortgaging questions, link in it or comment below. But yeah. Appreciate you guys watching it. Like, subscribe, comment, all that other good stuff. Until next video, guys, I really appreciate everything. Take it easy.